All right, here we are with the last example for chapter 9. And in this one, we're dealing with warranties. And so I'm going to show you a couple variations of this just to kind of make sure you get the full picture. But let's just start with the main story, which is on December 1st, Victor Company sold inventory at a cost with a cost of $2,500 to a customer for $4,000 cash. Victor Company offers a customer warranty for parts and services for 1 year. Based on historical evidence, Victor Company estimates that 4% of the sales will return for warranties services. And then on January 31st of the following year, a customer returned the inventory for a service cost of $150 of labor covered under the warranty. So let's do the first part, which is the sale. That's the obvious one. So December 1st, we're going to say cash of 4,000 because that's what we got. And we're going to, the counterpart of that cash, the credit would be sales revenue for 4,000. And then we also got rid of the inventory and we need to expense that. So another debit would be COGS or cost of goods sold for 2,500, and then the inventory would be the crediting account for 2,500. So that takes care of the sale. Then we get to the 1231 adjustment that we need to adjust for warranties. Remember, we're assuming that 4% of our sales are going to come back for warranty services. So we need to put that away, but we go ahead and need to expense it because we need to expense it in the same period in which we generated that revenue. So 1231, let's calculate what that's going to be. So 4,000 is our revenue, that's how much we sold, times the 4% that we think is going to come back. That's going to give us $160 that we need to set aside for warranty. So we're going to go ahead and expense it again. Our debit is going to be warranties expense of 160, and then we're going to put it into, because we're not actually doing it right now, we're not losing anything right now, we're going to set it aside because we're assuming that's what we're going to owe. So that is going to be warranties payable of 160. So that way when we actually do have inventory coming back, that's where we'll draw it from first. So then on January 31st, we actually do have some coming back, and it's going to cost us 150 to fix it. And so in order to do that, we would do December 31st, take it out of warranties payable for 150, and then take it out of cash of 150 to fix it. All right, that's the most basic form. If it's within what we put into warranties payable. So we put in 150, we ended up needing, we put in 160, we ended up needing 150. So that was pretty straightforward. Now let's look at something a little bit different. So everything's the same except this time on January 31st of the following year, the customer returned the inventory for services costing $200. Okay, so the first journal entry is the same. We still sold it for 4,000. It cost us 2,500. We still have 4% warranty we're expecting. So we're going to go ahead and put that in there. That doesn't change. It's still 160. But this time they brought it back. It was $200 it cost us. So January 31st, again, we're going to put warranties payable. We're going to take it out of warranties payable, but we can only take out what we have in warranties payable, which is 160. That's all we can take out. But cash is going to cost us $200. So we'll credit cash for 200. Now our debits and our credits are not equal. We're off by 40. So what are we going to call that 40? Well, that 40 is different than the 60 because the 60 that we put in warranties payable has already been expensed. This 40 has not been expensed yet. So we need to continue expensing any overage that we have. So we're going to put that into warranties expense. So that's what happens if it's more than what we put into warranties payable. Now let's take it one step further and read this last paragraph. Let's assume Victor Company sold more inventory on December 1st of the second year, again with a cost of $2,500 to a customer for $4,000. They remain estimating their returns for warranty to be 4% of sales. So if we sold it again, if we sold more the second year, we're going to have the same journal entry. So cash 4,000, sales revenue 4,000, COGS of 2,500, inventory of 2,500. That doesn't change. Then we get to our 1231 of the second year adjustment. So we need to do another calculation. Again, this year we sold $4,000 in revenue times the 0.04 gives us 160. Now pause here because that 160 is what we need to expense in warranties for the year. However, on 1231 of the second year, we have already got expenses. If you look, we have 40 already in expense. So of the 160, 40 has already actually been expensed this year. So what we need to do is expense the remaining amount. So it'd be 160 minus the 40. That'll give us 120. So our journal entry for the end of year 2, 1231 of year 2, would actually be warranties expense of 120 and warranties payable of 120. Because if you add up the expenses, that will give us 160 for the year. So please pay attention to that, because if you've already got some expenses early in the year, you need to take that out of your calculations. So hopefully that made sense, these three examples. If you have any questions, please leave us a comment below. Y'all have a good one.